All right, everybody. Welcome to the show.
All right, all right. Man, we're getting right down to it. Couple
Kinda-
days. I cannot wait.
I don't know. I just want it all to be over,
Lord.
but it's not going to be over that day. I don't think
No.
it's going to take a while, but one more step closer, though.
Yep. I mean,
Maybe all the advertisements will stop.
I just want to go walk the Appalachian Trail for until January 21st when
Something,
somebody else is in the White House,
Just
whoever
disappear.
it is. At any rate, we can't avoid it. So we got a few things to talk about on that.
All right,
This
what we
week.
got?
All right. So we'll do the regular what happened this week in the world of economics. And then we got a Facebook group post. These tend to all be kind of similar, but they're always good to go over. And then pre-election madness and the TSP fund charts. So Monday we get the Dallas Fed Manufacturing Index came in not as negative as last month, right? A lot better at -3 versus -9, which is good. The lowest negative reading since May of 2022. So manufacturing is definitely picking up, at least in Dallas. I think we did the New York Fed manufacturing last week, which wasn't as good. So things manufacturing-wise picking up. That's good. S&P was up 0.27% on Monday. Tuesday, you get the Red Book, which is year-over-year retail sales per store. So Red Book was 5.6 versus 4.6 previously. So again, better numbers. Year-over-year retail stores doing somewhat better. JOLTS is job opening labor survey fell to the lowest level since January 2021. So that's new job openings. Okay, so that basically means companies are announcing fewer positions is what that means. There's all kinds of ways that they do these numbers, and sometimes they're seemingly conflicting. But JOLTS is new job openings. So that fell to the lowest level since January 2021. So the employment picture is definitely softening, but the S&P was up 0.16%. So for some perspective, this is JOLTS since last October. And so there were a lot of new jobs being announced, not jobs created, right? These are jobs that are vacancies that are being opened by companies. It has been in a significant decline, right, all year. And we had a really low number in September. So that's one way of looking at it and saying that the labor market is weakening. Then Wednesday, we got 30-year mortgage rate up again to 6.73% from 6.52 last week. And along with that, right, we know that the 10-year yield continues to move higher, right, even though the Fed has begun this rate cutting cycle. And there's a lot of talk now about whether or not the Fed is going to be able to continue to cut, because the expectation is like 90% that the Fed cuts a quarter point at the next Fed meeting, which I think is the 7th of November. So it's going to be really interesting to see what happens with that, especially now because there's a lot of talk that the Fed did not need to start cutting rates because the economy is doing well. And so the obvious implication is that the Fed was cutting rates, and it did it by 50 basis points, which is a lot, and the economy didn't need it. So it can only be that because the Fed is trying to support, one administration or the other. It's every single thing. Everybody spins it back to the election one way or another. But the Fed is pretty independent. So at any rate, it will be tough for the Fed if they come out and don't continue to cut rates the day after the election. That will look really bad for them. So the S&P is down a third on Wednesday. Thursday, core PCE, which is an inflation measure, comes out. It ticked up 0.1%, right? So it's at 0.3% versus 0.2% last month, but it had a 0.1% forecast. So inflation is, I'll say rising 0.3 versus 0.1 forecast. It's not that much, but it's not. It didn't come down versus last month, right? It went up a little bit, which again goes to whether or not the Fed, if inflation, because this is the big thing, if inflation starts ticking higher, the Fed should not, this is a different conversation, but the Fed should not start cutting rates, should not continue cutting rates when inflation is moving higher. The only explanation, really, if the economy is doing well, unemployment is low, inflation arguably could be ticking up from here. Why would the Fed cut rates? Because the debt and deficit is so high that the debt burden is, what we have to pay on interest to the debt. When the Fed lowers rates, it lowers that interest rate. Imagine if you could lower the interest rate on your credit card bill. That's what the Fed is doing, right? By lowering rates. It creates all kinds of other problems, which is why it's a different conversation, but that's where we are. So inflation's higher than forecast. Personal income and personal spending both rose higher than forecast, which is good, right? It's saying that people feel like they have some money they're spending. It's also inflationary. Initial jobless claims were 216,000 versus an expected 228,000. So we had less jobless claims than expected, which is good. Means the economy is strong. S&P is up 1.86% on Thursday. And then Friday we had non-farm payroll. Non-farm payrolls is the number of jobs that are created, is how they term it, okay? Different from JOLTS, right? So non-farm payroll, 12,000 jobs were created last month. 12,000 versus a forecast 113,000. And we had 223,000 in September. It was the lowest job growth since December of 2020. And somehow unemployment rate remains at 4.1%. And then, we're doing this Friday afternoon, but at 10:15 this morning, the S&P was up 1%. So non-farm payroll, for some context, this is basically 12,000 jobs were created. I mean, if we're not creating jobs, unemployment has to go up. So 12,000 is better than zero, but it's not a whole lot better than zero. Hopefully, what do they talk about in here? Boeing had some big layoffs, and due to impact strikes at Boeing. I mean, they're trying to kind of figure out how this number could be so low. Let's just call it a one-off until next month and see what happens. But clearly the trend is down. Okay. All right, so we had this Facebook group post. So I have a question about how to grow the money that is already in my TSP. Right now I have the majority of my money in the G fund, so I will not lose it. So the question is how to grow money that's already in TSP. Right now, they have it all in the G fund so that I won't lose it. Like, those are two conflicting things. If you're trying to grow your account, it has to be in the stock funds when the stock funds are trending higher. If you're trying to maintain and conserve what you have, and meaning you're risk averse, then the G fund is the best place you can be because you won't lose it. So somewhere in there, right, is you kind of can't have it both ways. So if you're going to retire in 4 to 7 years, and just now started putting in 15%, I mean, certainly the most that you can, maxing out your TSP in terms of savings and getting the matching and all that is a great thing to do. That's completely a different conversation from which funds you should be allocated in.
Yeah, and it gets more confusing, that last sentence. So you
go ahead.
I mean, it's, so it sounds like old money, current money, G fund. New money going in gets divided up, mostly going to C, then some in the S, then some in the I, and then some in the G. Very interesting methodology. But it comes down to understanding what the funds do and how this works. And go ahead.
If we assume that, this person has 4 to 7 years to retire, then they've been at least contributing to TSP for some amount of time, right? Probably a significant amount of time. So presumably you got a decent chunk of money in the G fund, because that's where you're saying it all is, right? So that you don't lose it. And then your new money is going to the CS, I, and G. The percentage of the new money versus the amount that you have in your account is probably really low, right? If you're contributing, say, 2,000, 3,000, 4,000, whatever a month, with new money that's going into the stock funds, That's probably much less than what you have in the G fund now. So however you allocate the G fund is going to be where the bulk of your gains and losses happen. If you want to grow money that's already in the TSP, you have to move it from the G fund into the stock funds while the stock funds are trending higher. That's just how it works. But new money, I mean, yeah, nothing wrong with distributing throughout the stock funds. I would read our ebook and watch the podcast.
Yeah, hopefully you put that in the comment section.
Yeah.
Did you put a link to the ebook in there?
Probably, I don't remember.
Yeah. I mean, guys, the ebook is a great place to start. I know we're biased because we wrote it, but it at least gives you a sense. It's not trying to convince you to do it any certain methodology. What our ebook does is explain how all of this works so that you can put together a strategy, a plan. But you've got to start with kind of like a fundamental understanding of how all this works. Yeah. If you don't, then it's confusing because you're like, I want to protect my money, but I want it to grow. Well, that can't. Those are two conflicting things.
Yeah.
Fixable though, but yeah, I would read the ebook, and that's a good start.
Yep. Okay. Pre-election madness. So, this MarketWatch article came out on, what was that, Thursday? The 30th? This popular Trump trade may have run its course, at least for now. So the reason I picked this is because it's about yield, and it's pretty interesting. Rising Treasury yields may have reached at least a short-term peak, which is the same as saying if rising Treasury yields have reached a peak, it's saying that the F fund might have reached a bottom, right? Because price and yield are inverse to each other. And the reason that this article is saying that that's possible is because allies of Trump advocate for steep spending cuts. So one of the things that the people that I follow basically put Trump and Harris in the same bucket in terms of the economy, because both of them are talking about how they're going to do all these giveaways, and the giveaways are different, but no one is talking about cutting spending. And until recently, some of the people on Trump's team have been talking about what they're going to do for spending cuts, which if they do implement spending cuts, then yield will start to come back down, which is the point of this article. So one key ally of Trump grabs the headlines this weekend, suggests a $2 trillion spending cut in a second Trump administration. $2 trillion. Okay. So a lot of economists are saying that it's not feasible to do that. One macro strategist warned the newfound openness to trimming spending means it might be time to book profits in one of the more popular Trump trades, which is betting against government bonds. So yield has been going up for a long time, which means bonds have been going down. The F fund has been going down. TLT has been going down. But now might be the time to kind of book those profits if you were betting that the TLT was going down. Because if Trump were to get elected and he started implementing aggressive spending cuts, then yield would come back down. So the political betting market is certainly not downgrading Trump's probability of winning, but some reports now suggest that Trump would be open to aggressive fiscal spending reduction. If that pans out, the direction of the Trump trade could shift and reverse, and yields, right, Treasury yields, would fall, which means the F fund would go up. Possibility of such steep spending cuts was first floated by Elon Musk during his appearance at that rally in Madison Square Garden, but other Trump allies appear to be getting on board with the idea, according to media reports. Wall Street Journal reports that billionaire investor John Paulson is angling to become Treasury Secretary. If appointed and confirmed, Paulson would work with Musk to enact steep spending cuts. So this was actually, I went to the Wall Street Journal article. This piece is from that. Paulson, an ally of former President Trump, said in an interview that his priority would be extending the 2017 tax cuts that Trump had put in, followed by working with Musk to reduce federal spending, particularly getting rid of green subsidies, the Green New Deal. So that's kind of an example of how sector rotation would happen, right? If Trump were to win, there would be certain sectors in the S&P 500 that would do really well, and other sectors that would start to decline because he won, and vice versa. If Harris came in, we'd get more kind of spending towards infrastructure and the Green New Deal stuff, right? And it would be the reverse if Trump got in. So, but the index as a whole generally goes up. All right, so this I took from this YouTube video, and it's kind of interesting. The poly market, it's pretty cool. If you've never been to that website, it's pretty cool. You can bet on anything and everything. And a big chunk of what they have on there right now is all kinds of different things you can bet on this election cycle. So the poly market is the yellow line, okay, and it had Trump way up here. This was the day that the Fed cut rates by 50 basis points. No, that's wrong. That was back here. This was the day that Biden got out of the race. It was sometime around July 15th. So that's where they started this from. At that point, the odds of Trump winning was declining. Along with the odds of Trump winning, the blue line is 10-year yields. So 10-year yields are falling. They're basically rising and falling together, right? So it's almost like the bond market is either responding to or leading this idea of whether or not Trump wins. It's kind of fascinating. So as bond yields have been going up, this is when the Fed cut rates. As bond yields have been going up, the odds of Trump winning has been going up, which is pretty. It's interesting how closely this is correlating. This is DJT, right? So Trump's media company in candlesticks, and this is the 10-year yield, right? So it makes sense that it's correlating pretty similar to this one, right? So his media company, bottoms and starts going back up, but in the last couple days has absolutely tanked, and yield still continues to go up. So it's not the correlation is splitting, is what I'm saying, right? This is going down, and now this is going up. So the correlation is diverging. Don't know exactly what that means. I just thought it was really interesting to kind of point out. Does this mean now that there was so much movement? I mean, this was what? This is $10. This is $20 down here at the bottom, and it peaked at 54. So that was a heck of a trade. And then you lost, I don't know, half, if not more of it, over the past couple days. So pretty fascinating stuff. We will see next week, hopefully, who wins. Not super surprising in terms of seasonality. I mean, this is November during an election year. This is an average November. So not surprising, really, to see some kind of a pullback in early November. And then some churn, and then the last half of November and into December, the market moves higher. So this kind of volatility that we've had this week a little bit, not super surprising, and history would certainly suggest that we keep on moving to the upside, but we'll have to see about that. The thing that I'm kind of focused on quite a bit is this. The S&P 500. This is a weekly chart, okay, and it's going back to 2021, summer of 2021. So we're coming into that peak before the bear market in 2022. The black line is the NASDAQ, okay? It's QQQ is a ticker symbol. It's the NASDAQ, so it's really tech-focused. The red line is the S&P 500. And so we got the S&P 500 continuing to make new highs, right, at the end of 2021, but the NASDAQ had already started rolling over, and it's making lower highs. Okay, and then they all came down together. So the NASDAQ was leading the S&P lower. Okay? This is a relative strength of the NASDAQ. So when the NASDAQ peaked here, it price didn't roll over too bad, but the relative strength was collapsing. Okay, so the momentum, the momentum to continue the thing higher was just collapsing. If we fast forward to where we are kind of today, right, it's a little bit hard to see, but the purple line, the S&P 500, is making new highs. But the NASDAQ has put in a double top. Okay, a double top, you know, and it's rolled over in the past couple of weeks. So it hasn't broken down really hard yet, and it may not, but there's definitely a divergence there between the NASDAQ and the S&P that's not dissimilar to what it was at the end of 2021. And we also have a really big drop-off in relative strength in the NASDAQ. So, and we know that the S&P 500, it's not as tech-heavy as the NASDAQ, but a lot of the same mega-cap tech companies are in both the NASDAQ and the S&P 500. So from a big picture perspective, again, this is a weekly chart. From a big picture, it's worth kind of paying attention to the NASDAQ at this point. Okay, TSP fund charts. So it is the end of the month. So this last green tick is actually the beginning of November. So don't worry about that last green tick. The point of this is a very long-term chart, right? We're going back, this is 1996, and it's monthly. So each one of these ticks is 1 month of price movement. The 5-month moving average is that black line. The 20-month moving average is the red line. So if you are looking at a really long-term view, a career-long view of TSP, and you really don't want to, you know, you don't have the time or interest to track it really closely. What the first kind of step, the vast majority of the time, price is above that 5-week moving average line. Or sorry, 5-month moving average line. Okay. When it's not above the 5-month, any kind of dips that we have, it generally finds support at that 20-month moving average line, right? So as long as you're above that 20-month moving average line, ideally the 5-month, which is where you are most of the time, but as long as the black line is above the red line, price is generally moving higher on a monthly basis. These are the things we're trying to avoid in the big, big scheme of things, right? This was a 50% decline in the value of your account. This was a 55% decline in the value of your account. So those are the things that you're trying to avoid over the course of a career. That the little 1% up or down here and there, it's not, if you're retired, it matters, but if you're looking at it from a career perspective, these are the things that you're trying to avoid. And it's not hard to do when you look at it like this, right? Because when you get a cross between the black line and the red line, bad things happen. As long as the black line is above the red line, the overall trend is up. So there's very few times in your career where you're going to have to worry about big moves to the downside. And so those are really the ones. But if you don't keep that in mind and have some kind of reference chart like this, you would never know if it's coming. I mean, right now, obviously, the black line is well above the red line, the angle is up, and everything is good. That's not to say that we don't have volatility on a daily or weekly basis. But the bias right now clearly is that the trend on a monthly perspective is up. So if we go back to the weeklies, you got this is a weekly close as of Thursday this week. Okay, and there's nothing we can do about it. We're not waiting until the market closes every week and putting together the podcast on the weekends and all that. It's not doable not sustainable for us to do. So you're gonna have to keep that in mind. This is the weekly close as of Thursday. So as we're sitting here talking right now, putting the podcast together, it's Friday afternoon, and some of the market's probably going to close in here somewhere, right? It's not going to be as down as it appears on this chart. And even at that, you're above that 20-week moving average line. Ideally, if price continued lower, it would get support at that moving average line like it did here and here, and just keep on going, right? That would be ideal. This is a weekly chart. So if you're a subscriber to our site, you're getting much more detailed information. So definitely you want to be reading the market updates and the alert analysis and the newsletters, because you don't want to get confused if we're looking at a weekly chart that, as of Thursday, we're trying to avoid some confusion of what you might be seeing on the podcast here Sunday night versus what you got in your email box on Friday morning. Okay. S-Fund, same kind of thing, right? It's as of the close on Thursday, it's barely down at all on a weekly basis, right? Down 0.14%. So it's basically flat from what it was last week, and we'll see how that turns out at the close on Friday, but that's where we are as of Thursday. But again, trend is still up, right? RSI is well above 50 on a weekly basis. It looks good. iFund broke down last week, and the breakdown continues this week. Last week we had a close below that 20-week moving average line on the iFund, and it continued this week, and we got RSI below 50. So the iFund is not looking great. Definitely the weakest of the stock funds. And the F fund is kind of in the same boat. It broke down, big gap down last week, and it's continued down this week. So the article that we talked about, that this one Trump trade might be coming to an end, this chart would suggest that it's not. Until the trend changes in the F fund, and now that it's below that 20-week moving average line 2 weeks in a row, you would really need to see it get back above that line before it would be worth getting into. And the G fund, just because we can do it now, we put it up there. The G fund always goes up and to the right, but it just doesn't do it with very much of a rate of return. So even though the chart looks really good, if you actually looked at, this is beginning of 24 at $18, and now it's 18.62, that percentage move is 3% more or less. Okay, that is all I got.
Questions. If you have questions, shoot them to us in the comment section, wherever you find the video. If there's no comment section, you can shoot us an email, support@growmytsp.com, and they'll get that over to us. We love getting comments. We love getting questions because it helps us know what you guys want to talk about on the podcast. And so
Absolutely.
Give us the feedback. And hope you guys are having a great weekend, and hope your
team wins.
Yeah.
Whichever team
whatever your team is. Let's just hope we can all make it through it. Take care, guys.
Later.